G'day. Welcome to the Financial Bloke podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier, and more prosperous life. My name's Ben Law, and I am the Financial Bloke. Warren Buffett, who's one of the world's most successful share market investors, once said, "Investing is simple, not easy." I first read those 5 words early-ish in my financial advice career, and I remember thinking, I just don't get it. Investing isn't simple. You see, like most people, I was taught that complication was just part and parcel of investing. And in actual fact, it was a crucial ingredient required for success. But wow, I couldn't have been more wrong. As I became more experienced, it became crystal clear to me that complexity is the enemy. The more complex your investment strategy, the more moving parts, and therefore the more chance of something really stuffing up. My time working for a hedge fund in London and working through 3 significant market downturns, which included the GFC, taught me that exact lesson. I learned that at its most basic level, investing was very simple, and to be somewhat successful, you didn't have to learn all that much. But investing definitely isn't easy, because learning those key factors you need to know to be successful, you either need to find someone that'll teach you, or you need to learn from trial and error and the school of hard knocks. And that, my friends, isn't easy. What I've come to realize that if you want to be a successful investor, you need to do 3 things. Number 1, you need to learn. You got to educate yourself. Number 2, you need to take action. And number 3, you need to review what worked, what didn't work, and then go back to step 2, which is take action. And no matter how many years investing you have under your belt, you need to rinse, wash, and repeat steps 2 and 3 and never stop educating yourself. Most people ask me, so how do I start investing, Ben? And the first step is to start educating yourself. And today we're going to begin that journey. Our guest today is my mate, Ian Boda. I got to know Ian many years ago when I was a young advisor, and he was a young business development manager. Ian now works as a national development manager for Vanguard. For those of you who haven't heard of Vanguard, Vanguard's one of the world's largest investment companies, and they manage over $7 trillion for investors throughout the world. And yep, that's $7 trillion. Now, Ian's a good mate of mine, and he's a really smart cookie. He's a certified investment analyst, and he was crucial in helping me educate my advice clients on the timeless investor philosophies that were instrumental in their success. Now, complexity is the enemy, and education is your friend. So on that theme, Ian and I will be having a conversation about the simple things you need to know when investing in the share market. Now, before we start today, I want to be really clear that this is not financial advice, this podcast. Any mention of Vanguard is not an endorsement or a recommendation. It's just a couple of mates having a conversation about the fundamentals of investing. And if you do want to go invest, go do your research, go speak to a financial advisor, and make sure you implement something that's appropriate to your needs and circumstances. So, again, not an endorsement of Vanguard or any other financial product out there in the market. So on that note, we better get cracking. Welcome, Ian.
Thanks, Ben. Great to be here.
Fantastic. Okay, so where we'll start off is the same place we start for everyone, which is for us to get a bit of a better idea of who you are as a person. What would you say is one of your key personal values, and how do you think that's contributed to the person you are today?
Definitely. It's I had to think about this one, Ben, when you asked me to come on the podcast. But I'd say that the one that stands out the most to me would be, the harder that you work, the luckier you get. And, something I've always tried to do my whole life is, make sure I prepare, or I've done enough preparation or done enough reading. And, it always opens up opportunities or makes you feel like you've been lucky when maybe it's just been really the preparation. I think if I think about maybe as, when I would have been talking to you, when you're a financial advisor, Ben, it's like that old saying that you may have used with clients, failing to plan means planning to fail. Just to be a bit cliche, but I think it's really true. So, that's definitely held me in good stead throughout my, personal and professional career.
And it's a pretty true one. I always say that the harder you work, the luckier you get. And I've always run by that philosophy as well. So that's good.
The other actually bit, mate, just I'm thinking out loud was maybe it's not a value of mine, but I do love reading. I do love trivia. So I don't know if all those little facts end up being useful or annoying for people when you have a conversation at a dinner party. But, both of us have got young kids, and my daughter's absolutely infatuated that the national animal of Scotland is a unicorn.
Really? I didn't know that. There you go. So, let's tell Sophie that one.
No, definitely.
Yeah. Yeah. Well, Sophie, my little daughter, we talk about facts too, because I think it's good to build their knowledge early on. And she always says, Dad, tell me some dinosaur facts or tell me some unicorn facts. So that'll be a great one.
Awesome, mate.
Now, every investor and advisor have their own opinions on whether to invest in shares or property or any other asset class. And we're not here today to say shares are better than property or property is better than shares or you should buy Bitcoin or bonds, etc., or shares or managed funds as we go through. But if you do decide to invest in shares, I thought today would be really good to talk about how to go about it. And we're going to dig in to get a better understanding of the options available. And I want everyone to keep in mind that I'm all about simplicity. That's where I come from. Not everyone agrees with me. A lot of advisors out there believe, you need to make things more complex. The more complex, the better outcome you'll get. But I come from the exact side of the coin. So that'll be flavored right through today. So where we might start, Ian, is, what are the options available to us if we want to get into shares?
Yeah, no, definitely. So there's a range of ways that you obviously can invest. Ben, if you're wanting to invest in shares, I think maybe just starting first with how Vanguard thinks about investing and our investment principles that we have as a firm. When it comes to investing, we really have 4 principles first, which are, set your goals or have a goal in mind for what you're wanting to do. Have a very balanced or diversified portfolio so that, you can sleep at night when you're thinking about trying to achieve or attain that goal. The third one is keeping costs low as possible. So we'll talk about costs probably throughout this and, how they can potentially be a drag on or a hurdle for you reaching your goals. And then finally, discipline, making sure that, you can withstand all the peaks and troughs that come with investing in the share market. So if you think about that in mind, when it comes to shares, there's probably a range of different products as a investor you could use. So there's things called a managed fund, which you would have used time and time again for your clients potentially. And I mean, a managed fund is essentially where you as an investor can pool your money with other investors and have an opportunity to buy many different shares at a lot lower cost, and then obviously enjoy all the capital growth and the income or distributions that are paid out from those. So even if you think about Vanguard or the ASX 300. That's buying the top 300 companies in the Australian share market. You could either try and purchase all 300 companies your own if you wanted to get that diversification yourself. But with that comes a lot of costs, in terms of trading and costs in terms of rebalancing if you're wanting to try and keep it to a particular type of diversification, in terms of size of the companies in that index. Or you could pool your money in a managed fund. Like we have, and do it that way, where you essentially put all your money, you pay a small fee for the portfolio managers to manage that for you, and then they will do all the professional management of the holdings, reinvesting any dividends or distributions, giving you the tax statements and everything else you may need. So you've got that option there, which you can easily access via other platforms as such, but they call it a managed fund or an unlisted fund. You may have heard that term as well.
And then obviously there's the direct. You can, as you said, go directly and buy Commonwealth Bank shares, Woolworths shares, whatever it might be you want to buy. To get the two, and they're probably the two ends of the extreme, aren't they? Where you have full control, where you choose on what you buy, and then at the other end is a managed fund type scenario where you have to pick a fund or a number of funds, but you have less choice and you sort of outsource the management of that portfolio, with the idea being that professional fund managers should be able to do a much better job than someone that's never been involved in that. It takes a lot of the risk off the table in many ways.
Yeah, and it takes time as well. I mean, like time to buy and sell, if in the example I use, 300 different holdings is, one, costly, but also a lot of time to manage. You're probably going to get 300 different statements in that you then got to reconcile and do something with at tax time. Or, like I said, you can actually focus on those 4 investment principles that I mentioned of, understanding what you're actually saving for, or investing for, I should say. Have a nice balanced portfolio where someone can do that for you for a very low fee in terms of managing all the holdings that are a part of that. And then, if the costs are low, it's probably a good time versus cost trade-off for you, as an investor. And then, all you need to then really think about is the discipline piece, which is, I said I needed to save for 5 years for X, rather than, every day or every month having to go in and do some sort of trading or rebalancing. You can worry about other things like spending time with your family or doing, your professional career or whatever it might be. Direct equities, I mean, Australia has one of the largest there's more and more people in Australia that actually invest in direct equities, I think, than anywhere in the world. But there's more and more people that are now looking to, manage funds or ETFs, which are also exchange traded funds, which are essentially, if you haven't heard of them before, they're essentially a managed fund which is listed on the ASX. So it's another way of being able to buy that fund of 300 different shares, using CommSec or a different type of online broking service. But it's listed, so people have been getting into investing that way as well. But it's literally a managed fund which is listed on the ASX.
Yeah, and it's interesting. Just full disclosure for everyone here: I spent 20 years as a financial advisor. I worked for a hedge fund in London, so I had a really good understanding of how to buy and sell and trade direct shares. I personally chose over the years not to invest in direct shares, to actually invest via managed funds, because I didn't have the time, energy, or inclination to be trying to do all the research and the discipline to be able to go in and buy and sell and do the research on each individual stock. And what I found is that to outsource that to someone else made a whole lot of sense for me personally. And still I have that philosophy today. I outsource that. I don't have the time to do it all the time. Now, one of the interesting points probably is, Ian, is this diversification. And I think we just want to touch on that a little bit. So diversification basically means not all your eggs in one basket. So if you think about it, and I'm a farmer's son, so I quite often use farming or rural type analogies. But if you think about a farmer, if you just grow cotton, you're just a cotton farmer. If you say grow cotton, wheat, sorghum, barley, etc., you might be a cropping farmer, but you've got a little diversification. You're not getting all your income from cotton. That's diversification in its simplest form. Another way of looking at diversification is to have farms in different locations. So you might have a property in, say, Claremont, and then if you had another property in Hughenden, and then one down in Hay in New South Wales, you've got geographical diversification. And so when it comes to investing in shares, you want to invest, don't you, not only across companies, but you also want to be across different sectors of those companies, whether it be mining or banking or health. And also geographically, you don't just want to be investing in Australia, do you?
No, definitely. And I think in diversification, that they often calls the only free lunch in investing, and it's one of those things that people take for granted until it can potentially bite them in the bottom, right? So exactly what you said there, Ben. When it comes to investing, diversification isn't just always geographical, or not always just certain farming types. But when we think about investing, it's across all the different sectors of the Australian economy or the international economy. So you often find, when I do talk to clients or advisors and the clients that have come in and seen them, if they've been investing in shares, they usually have the 4 banks and the 2 miners, and they think it's a diversified portfolio. And yes, you've got 6 stocks, which is great, or 6 different businesses that you own, but in reality, you've really got 2, because you own 4 in the financial sector and you own 2 in mining. So there's many other sectors, or when I say sectors, other different industries that you can invest in, from healthcare to consumer staples to technology and the like. And that's the reason why people go and invest not just in the Australian market but overseas as well. So the Australian market's very known to be concentrated, which just means there's several large companies, that essentially make up the market in a small, narrow subset of sectors or industries. I think, one of the statistics I saw was, the top 70% market capitalization of the Australian market is in 30 companies. So
which worldwide, that's pretty unheard of, isn't it?
Oh yeah, it's definitely not the norm in that sense. And in Australia, we tend to be a lot lower in technology and healthcare. So if you invest in the Australian market only, just thinking about that regional, that geographic piece you mentioned, Ben, then you're really missing out on other opportunities that, that are overseas. So we're often talking to advisors or to clients to invest into, equities or into shares outside of the Australian market as well. So, the US market or Europe or Asia, or, Vanguard, we talk about investing just in the international shares fund, which allows you to, just capture all those different other sectors and larger companies that we use in our everyday life. So, we're using Google, I'm on a Microsoft laptop this morning. There's all these different companies that if you didn't invest overseas, you would not have the diversification or the opportunity to participate in owning those companies and the growth that they're going to have. I think one other part as well, Ben, is that, people often try and time which sectors to go in or which geographies to go in. And, that's the difference, I guess, between, what Vanguard's known for, which is, index investing, which is just owning the whole market, or you can be what they call an active investor, where you are trying to select certain, areas or companies that you think are going to perform better than others in the future. Now, both of them on merit, are great investment strategies to choose. But, what we often find is that, costs play a big role in terms of, being able to eat up the extra returns that, say, an active strategy may capture versus index funds. When we talk about, we often use the terminology of why try and find the needle in the haystack, like that number one company that you think is going to be the best performer, when you can just own the whole haystack. So indexing, just using that farming term, index is like essentially you can own the entire haystack at a very low fee, or you can try and select an active strategy that's looking for those small haystack needles that, are going to outperform or give a return larger than the market, the broad market itself. So, there's pros and cons with both, but, the way I often talk about is that everyone loves active investing because it's this thing you can talk about at a barbecue.
Well, that's why people like direct shares. Quite often I've found, and that's a great point, because people go to the barbecue or talk to family and friends and they say, oh yeah, I've just bought some BHP shares, or I bought the latest tech stock, or whatever it might be, and I've done really well out of it. So when you talk about managed funds, it's quite often far less sexy to think about. And then when you go from managed funds down to index funds, it's even less sexier again, because it's on the surface very boring. But quite often it's the boring that'll far outperform anyone. And I'll talk about Land Cruiser investing a little bit down the track, but that's where the secret to success is sometimes boring just works.
Yeah, there's the saying, boring money, exciting life, or exciting money, boring life, and I think when you think about investing, I'd rather have boring money and an exciting life. So, but everyone loves talking about the sexy stock, or the one that's sort of, in vogue at the moment. They never like talking about the losers that they've held as well, that, potentially have reduced the amount that they've actually earned over that time frame also. But I think it all comes down to, when index and active investing, like, we're proponents of both, Ben, just so you know, but when it comes to active investing, like I said before, you've got to keep the costs really low. Otherwise, the actual alpha or returns above the market that they generate just get eaten up by the fees, and the fund manager ends up the only one getting rich, not the client. So as long as the fees are low, there's an opportunity to use potentially both strategies in a portfolio. But that's been probably the biggest hindrance in the Australian market.
Yeah, just rewinding a little bit, Ian, back to the needle in a haystack. I used to always say it's like trying to pick a stock that's just skyrocketed and you've made a lot of money out of is a little bit like Willy Wonka's chocolate factory with a golden ticket. Someone will have got it, and most likely it's by accident, and the vast majority don't win. So it's better off to buy a ticket to the chocolate factory and go with everyone else, rather than just put all your money, so to speak, on winning that one ticket. Now, for some people, winning that ticket is what they're all about, but for the vast majority of investors, they just want to go to the chocolate factory, don't they?
Yeah, they do, and I think often when you hear about the winners, it's probably too late as well.
Of course, it always is. Yeah. So if we just go back a little bit, so basically we've got direct shares where you can go buy those shares. You decide what it is you want to actually buy, and then you can go to a managed fund. And the two options we've got is you can have something like an index fund or a actively managed fund. And the way I've always explained that, just to simplify it a little bit, is if you can imagine an index fund there's say 300 shares that are on the stock market, so 300 companies. The company that you invest, or the index fund that you invest in, goes out and buys those companies for you. So they buy those 300 shares and they hold them, and then they hold them proportionately. Whereas an active fund on the other side there's some person or a team of people that are actually buying and selling and trading shares all the time. And that's why it's called active versus passive. And there's pros and cons, as you said, with both. But generally, an index fund is far cheaper to run than an active fund And it's for obvious reasons because, something's being actively managed and passive. Now, what I would like to touch on there just briefly, Ian, is active and passive also will perform differently at different times. So the general consensus has always been in a rising market, passive funds will generally outperform. On a declining market, it's the other way around, but we haven't always seen that. Now, it's important that we look at the longer term when it comes to investing. And I know Vanguard does the research and reports. And last time I looked, it was something approximating 85% of active fund managers after cost don't outperform the index funds. So that means for all these really smart people around the world that are buying and selling and trading over 10 to 15 years, can't beat the index. So there's a small argument for just putting all your money in active funds because you've got to pick the right fund and that right person that can consistently outperform the market. So do we want to just touch a little bit on that, Ian?
Yeah, no, definitely. So it's the reason why I guess index investing has become so popular, especially since the GFC, Ben, where, you mentioned that active managers had always said that, that they're more likely to reduce the impact of a falling market, than an index strategy, which just has to follow the market. And I think what they found on average during the GFC was that most active funds didn't. They fell further than the market. So ever since then, we've seen a lot of, money just transition over from active management to index funds over that time period. But what's interesting, when I think about that, is that there's a group called S&P, Standard & Poor's. They do what they call an index versus active scorecard every, 6 months. So it's SPIVA for short, if I was to use those terms. And when they look at 10-year figures for international equities and how many active managers outperform the index over that time period, it's about 20%. So it's only 1 in 5 versus what's still interesting, even though passive or index funds have been more popular over the last 10 years or more, majority of the money is still tied up in active management. So it's still, even though they only outperform 20% of the time, about close to 80% of all the money in the professional investment market is still actively managed. And I think, if people are listening to this, they're probably going, why would you bother and, go in active management? And I think that's a fair question. And everything comes around to framing. I think more people would consider indexing for either the core of their portfolio or their entire portfolio, Ben, if the question was framed a bit differently. So I think about it like this, when you look at those figures from the SPIVA report, if you said to someone, would you like to pay about 5 times more in price or than an index fund with a 20% chance of winning or beating the market, or would you like to pay 1/5 the price of an active fund and beat the average active manager 80% of the time? I mean, if you framed it that way, which would you choose? You'd pick the index fund all the time. But I think when it comes to active management, the hope, like you said, or finding that needle in the haystack or having that barbecue story is meant that, there's still a lot of people that are looking to, potentially get rich quick rather than say get rich slow and sort of just build wealth over time and use those investment principles and the like to sort of get themselves get them wherever they want to be in terms of their financial goals.
Yeah, and it's unsexy. I mean, that's the whole point, isn't it? Now, one of the things I saw a report you did a few years ago in a presentation. I went to a professional development day, and it was and it really resonated with me of what I was seeing, and that was the fact that also too, though a lot of the active fund managers back when I first started in the industry 15, 20 years ago, actually within 5 to 10 years, it all disappeared. So they'd been top performers, and then 5, 6, 7 years later, they were gone. And for me, that was so being able to pick one that'll be there, because the fund managers will basically look at it and go, okay, well, if it's not performing, we'll pull it out of the market and replace it, because it's very hard to pick up the return once you've been through a poor performing market. So that was really interesting to me. Now, where I just want to go back now, Ian, if that's okay, mate, is so we've got active versus passive. So we understand how that sort of works. And we've talked about exchange traded funds. So if you want to get into a managed fund, you've essentially got to go through a provider, so a platform as they call it. So you've got to, and generally for most people, they've got to go through a financial advisor. I mean, I know there's options out there, like you talked about, Vanguard's released recently, but you've got to generally go through that. Or the other option is you buy one of those funds on the stock market, and they're called an exchange traded fund. So most funds have a lot of funds have got those. Then I want to talk about, okay, well, let's assume an ETF or an exchange traded fund and a managed fund are essentially the same thing, just different ways of getting in the front door. When you get into an exchange traded fund or a managed fund, you've then got options in there, don't you? So you can go into something called a sector-specific fund, or you could go into a diversified fund. Do you want to run us through the difference between those two? Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode.
Yeah, definitely. And you're right. So it's definitely just different entry points into the same pool of assets, whether it's a Vanguard fund or a Vanguard ETF. So it's just access point, like you said. And we're agnostic to whichever one a client or an advisor wants to use. But when you do enter in via an ETF or exchange traded fund, there'll be a range of different options. So I think there's over 200 different ETFs you can purchase on the Australian market now, and there'll be a range of different product sets or profiles. So you mentioned sectors. If you wanted to build your own portfolio and have your own tilts and, customize it the way you want, you could buy an Australian shares one. You could buy and just own the whole market. You buy international shares, the whole market. You could buy the property trusts or, REITs, real estate investment trusts. You could buy fixed income, when we talk about, like all the defensive assets bonds, that's Australian or global. You could buy government bonds. You buy corporate bonds. They essentially allow you to slice and dice it, in many, many different ways as possible. And then you could build that yourself and do, 5 or 6, 7, 8 different sleeves, if you want to call it like that, and purchase on your own. Or you mentioned like simplicity, before, like keeping things simple. Or you could purchase what we would call at Vanguard a diversified fund, which essentially, we have 4 of those that we've built across the conservative, balanced growth and high growth profile. And what that means is they're just split differently in terms of how much they have in shares versus how much they have in bonds. So, the team at Vanguard, we have a group called Investment Strategy Group that do, all our work on asset allocation, as they call it. So working out how much return you can achieve by how much risk you need to take across those 4 different profiles. And if you've, got a goal where you think you only need, X% return, the balanced fund might be appropriate for you in terms of how much return's needed. But, in terms of how much risk you're willing to take, like how well you can sleep at night, you might need the conservative funds. So then you've got to do a trade-off between the two in terms of working out which one you'd need to go into. But those 4 options, just so you know, Ben, essentially we use those sleeves, like I mentioned, that you have a range of. We put them together in a portfolio or an asset allocation as such, where it's got X amount of growth assets or an X amount of defensive ones, so shares and bonds. And then you would just use that as your one vehicle to, either regular savings plan or dollar cost average, if you want to call it that, or if it's a lump sum, put into there to just essentially ride over the time frame that you need to achieve whatever goal it might be. You've also got other options, so I've just spoken about those, but then you've got all these other options, I guess, Ben, where you can go, well, I just want to be invested in Europe only, or I just want to be in the US market only, or
Well, you see that a lot, don't you, with people that say, look, I want direct shares. That's my thing. I want to buy BHP, Rio Tinto, Woolworths, Coles, and that's their thing. But then they say, I want a geographical exposure overseas, and I can't go and buy Apple shares or Coca-Cola shares overseas. So you buy one of these ETFs or exchange traded funds that are an international share fund, which then gives you that exposure or diversification to the different market.
Yeah, and that's exactly right. So you can either buy the entire international market ex-Australia in one ETF, or you could go, I'm going to buy the US, Asia, and Europe as an example, but I'm going to choose which weightings I've got to each of those different regions. So you can be as involved as you want with ETFs as well in terms of building out your asset allocation or your investments, or you can, do like a one trade solution that can essentially encompass it all. We talk about our products being outwardly simple, but inwardly sophisticated. So, it might look like a one-stop solution that you're purchasing, which it is. But, the actual mechanics and the thoughts behind the asset allocation and the products that are used and trying to match your risk return profile as an investor, there's a lot of work that goes into that on an annual basis that they also are doing the oversight on and seeing if they can improve it on that, people don't really see, right? So, you think about like the barbecue story. If you just say I bought a growth fund versus someone who goes, well, I've bought the US, the Asia, and the European ETFs, and I've got X amount split here. You can see who's going to have more people around them at the conversation at the barbecue. But in reality, this is just outwardly simple. It's inwardly sophisticated. We're doing exactly the same, except for it's it's a one ticker solution.
Yes. If I think about it this way, Ian, too, is you can have as much control as you want. So you can effectively have direct shares and then match up some international or different funds to attach to it to give you diversification. You could go all into funds, so to speak, or you could go into a multi-fund that's being managed by someone else. And just as you go up the chain, you're most likely you're outsourcing more of the management to people that, in theory, will do a much better job than you would over time. But I think it's really important to note that simple, as I said, is really important, but you're never going to shoot the lights out. So when you take the simple strategy and the robust strategy, you're never going to necessarily get the best returns in the market and be that person that says, wow, I bought Zoom when they were, $1 a share and now they're worth $100 a share or whatever they are. I'm just making the numbers up there. You're never going to get that. But what you're going to do is that dependable. And that comes back to Land Cruiser investing. So one of the analogies I've used for years, and the reason I've used it is just to illustrate a point, is I always talked about, and my whole business as a financial advisor was based around this Land Cruiser philosophy, which is, basically, it's simple, but a really effective tool that does the job. So if you get in a Land Cruiser versus, let's say a Ferrari. So you get in a Ferrari versus a Land Cruiser. Now, in their own jobs, like if you take a Ferrari on a racetrack, it's going to far outperform a four-wheel drive, isn't it? But if you take them out on off-road, the Ferrari's never going to survive. So the Land Cruiser philosophy was find something that's solid, dependable, and reliable, because that will get you where you need to in the long run. And I believe over the years that the more simplified I made things, the less chance of things breaking and things going wrong. Because what happens in investing is, for a period of time, you start to forget about risk. So when the markets keep going up, as advisors and as investors, we start to forget how much risk there is. And then when the portfolio or when the markets go down, we remember how much risk is, and then we get really risk averse. And what happens is discipline goes out the window. And I've always said people substantially underestimate the risk of their long-term success based on their advisor's discipline. And so using something like a diversified fund, etc., or some sort of managed fund can actually reduce that risk, because when you're in, you've got professional people with essentially level heads that can look at the data and make choices that will give you the best outcome long term, not short term. No,
mate. I've seen you use that analogy a few times, and I do remember the pictures, and I love them in doing that. And I think when you think about a financial plan, or a goal that you've set in mind, everyone always has that mountain with the flag on the top. So if you even think about it that way, Land Cruiser has got to go up and down creeks and little hills, and there's no bitumen road that sort of takes you all the way to the top. So I think, I don't know if work likes calling our strategy a Land Cruiser versus a Ferrari, but in terms of actually having a goal and getting there, there's always going to be ups and downs, peaks and troughs. The products are always built to essentially weather as much of that as possible, and hence why they're often the core of a portfolio, or sometimes an entire portfolio for people trying to achieve a particular financial goal.
And I think probably where I was getting at is, from a financial advisor's point of view, I always looked at the strategies we put in place for more Land Cruiser than Ferrari. And sometimes people want Ferraris. Sometimes people need Ferraris. That's just the way of the world. But for me, that's what I actually liked. Now, the other thing also too is I want to talk a little bit about is geared investing. So you'll see things like geared investments, which basically means you're borrowing to invest. And there's two ways you can do that. One is you can go to the bank and say, look, I'd like to borrow $100,000 and I'd like to invest invested in something. And obviously when you buy an investment property, you go to the bank and say, here's my deposit, I'd like to borrow some money. That's gearing or geared. And so you can also get the same thing with managed funders as well, where you can actually buy geared share funds. And they were really popular pre-GFC. Then the GFC came and everyone that had geared share funds had a really tough time. So do you want to talk a little bit about how the geared share funds work, or briefly, Ian?
Yeah, sure. So I mean, gearing, really should be called magnifying, because it essentially magnifies the returns, positive or negative, on your existing capital that you have. So like you mentioned before, you might have $10,000 and you borrow $10,000. So you've now got $20,000 to invest. But with gearing, what it means is, if the market goes up, you get extra returns, because you've now got double the amount of capital in the market. If the market falls, you have potentially double the losses as well, right? Because you've had more in the market, which means you've lost more as well. Gearing really, is a strategy you probably talk to an advisor with to work out if it's something you need to do, because it is an extra risk that you take on. And
as you said, magnifies the risk. Correct.
Yeah, magnifies the risk. Well, everyone talks about magnifying the return, but it also magnifies the risk. And I think, there's a couple of ways that people do it. You mentioned one, you can either go get a margin loan, as they're called, and borrow, or an investment loan, same. Or a lot of people tend to use equity in their property, and borrow against that. But either way, you're gearing and you're using money that you don't currently have to put into the share market. It's a sound strategy if you're only gearing a small amount, Ben, most likely, and if it fits the goals and the time frame and the circumstances that, that the client's looking for. But in terms of, using it as in the strategy, Vanguard doesn't offer geared funds. It'd be more that you can use our funds with a margin loan and you could, add the extra capital yourself. But it's something that, I guess Vanguard hasn't been comfortable to run in any of our products as of date.
But they're out there, they're available, and they need to be taken with care. And I think why I wanted to touch on that, Ian, is I saw a lot of people back pre-GFC and that borrowed huge amounts of money to invest in the markets. And I won't even mention the names, but there was a few very large companies that collapsed. And so gearing can be a good thing, but it also can be bad if you don't know what you're doing and investing in something a little bit higher risk. But you can buy funds out on the marketplace that actually have gearing in there. So the managers actually borrow.
Yeah, and they're called internally geared funds. And you see, in my time, I've seen that a lot where advisors may have used that for younger clients, that potentially can weather the storm more. So, if the market's up 50%, their fund is up 75%, and if market's down 50%, their fund's down 75% as well. So it just magnifies those returns. And I think people forget that, that, like you said earlier, they're all happy when the returns are going up and they're all getting pats on the back. But when the market falls and they realize that it's fallen even further because of the gearing that's been involved, or the internal gearing in the strategy, that's when the questions become asked of the advisor, or, is this a sound strategy, or can I sleep at night knowing that, this has happened, and do I want it to happen again in the future?
Yeah, it's knowing that risk, and that's experience. I mean, when I was 20 years as an advisor, I saw 3 significant market downturns. I mean, I entered the market after I finished uni, just as at the turn of basically end of 1999, I got my first job in financial advice. And I remember, I've told this story many times before, but I'm going to tell it again because it's one of my best lessons. Is I'd worked on cotton farms the whole time I was at uni to pay for myself to go through uni, and I'd managed to save about $4,000 because I was a good saver. And I got into the industry, and the tech industry was absolutely booming. It was just unbelievable, and the returns were about 100% coming out of the tech market. So there was funds out there that you put $100 in, or $100,000, 12 months later you got $200,000. It was unheard of, and the internet was coming out. Everyone was super excited. So of course 22 or 23-year-old Ben was like, I've got this $4,000. Do you know how many hours I had to chip cotton and drive tractors to build this up? If I put this in there 12 months from now, I'll have $8,000. And then of course 12 months later, after that, I'll have, 16,000. Do you know how good this would be? And of course, everyone said to me, Ben, diversify, don't put all your eggs in one basket. So 23-year-old Ben went, no, bugger that, I'm in. And I threw the whole lot in, and 12 months later, I got out $400. And it never recovered. And that was the greatest lesson for me ever about diversification and risk is you've got to experience those things sometimes to be able to learn the lessons. And you want to do that when you're 23, not 63 with your retirement nest egg. And I think this is where we probably want to touch a little bit on risk in a little bit as well. But the other thing, Ian, can we just touch also too on currency hedging? Because that was one thing that whenever I talk to people within the portfolios I used to construct, we used to have currency hedging in there. which basically reduce risk a little bit in our clients' portfolios. So do you want to talk a little bit about currency hedging and why that's important?
No, for sure. Yeah, so currency hedging. So as soon as investing in the international shares, as soon as you go off the Australian market, obviously you're trying to invest in companies that are going to grow their capital and pay a dividend or distribution. But as soon as you invest overseas, you also then have foreign currency. That's another risk that you take on, and currency fluctuates. And we all know when we go traveling, we all want the US dollar to be close to 1 so that we've got a bit of parity, and you actually don't mind if it falls to 70 cents if you've got any US dollars back when you're coming back into to Australia to exchange your money back into Australian dollars. It's the same when it comes to investing. So to remove that risk of the currency moving up or down, many people like to what they call currency hedge their international equities or their investments so that risk is removed altogether. So the only risk you're taking is the risk of investing in those companies and the company's price going up or down. You find when people have invested in the US, I would just use the US market as an example because everyone knows the US dollar. You could have invested $100. The market's gone up 10%, so it's now worth $110. But the actual Australian dollar has gone from 80 cents to $1, so it's gone up 20%. You're actually behind, right? As an
You've
Australian,
made a loss.
Contrary, the other way around, if the market is $100, market's gone up 10%, it's now worth $110. The US dollar was $1 and it's gone down to 80 cents. That's a 20% gain. So your investments are probably worth $130, just using rough rules of sums there.
Again, it magnifies.
Yeah. So by hedging, what you're doing is removing that currency fluctuation so that you will always get the 10% return, as I'm using that example, without the currency either increasing or decreasing your overall return. So by doing that, you're just removing some of the risk off the table in the short term. A lot of the research that Vanguard has done, Ben, has shown that, hedging long term, probably doesn't make a difference. You could be unhedged or hedged if your time frame for investing is long enough. But in terms of, that shorter term time frame, using some sort of form of currency hedging on a portion of your international equities, is a sensible strategy. Just so in our diversified funds that we have for all our assets that are in international shares, we hedge 30% of those back to Australian dollars. So, we don't do it. It doesn't have to be a binary decision of one or the other. It might be a portion. And, you often get the people say, I'll sit on the fence and go 50-50. I think as long as it allows you to sleep at night, the strategy is sound. You're not really taking a bet either way in that approach. But yeah, it definitely just helps reduce the short-term risk.
Yeah, and I think it's really important because just to use in very simple terms, I've seen this happen over the time, Ian, where we've seen markets drop and then having a conversation with a client and saying, look, the US market's dropped 10%. So theoretically, if let's say we had $500 million sitting in the US side, your portfolio will have gone backwards, but the currency's changed, so you've actually made a profit. And trying to get their heads around the fact that, but the assets have gone down, but our price has gone up, and vice versa. We've seen a great year in US equities, and you actually made a 20% return in your US shares this year, but unfortunately currency changed and that's wiped it all out and you've made nothing. So it is important to the decision making, and it can be used to mitigate risk, but it also can be used to increase risk because some people are able to bet against the market. So they're saying, look, for example, the US is really high. We think it's going to come down, so therefore we'll hedge or unhedge a certain portion, or vice versa. So it can be used by some people to do that. Personally, for me, it was always about reducing risk. But for many active fund managers and things like that, that's part of their job. They look at currency and they try and hedge it. And I know when I worked for the hedge fund in London, which is slightly different to currency hedging, but I used to sit right next to the team that did currency hedging. That was their full-time job, was just to hedge currency all the time. And it was a stressful job. Like, these guys had a short life expectancy. They used to always joke that they've got 10 years currency hedging and then you can open the window and jump out. That's why they put the office on the first floor, not the 10th, was so that would happen. But there was lots of money to be made for the company, but it was also high risk and highly stressful. So, currency can be used as a leverage tool to leverage up returns, but it also can be used to lower risk as well, as you mentioned, which is good. So that's that there.
I think, when it comes to gearing or deciding whether you want to hedge or not to hedge your currency, all these choices, everyone's always thinking about the returns that you're going to make more. I know you're talking about risk, Ben, but everyone always talks about the returns. And, one of the things we always remind people about when investing is that, it's always good to know how much you need to make, but like you got to also try, think about when you build a diversified portfolio, like how much is it going to fall, how much can I stomach, and how much can I make back? Because if you think about if the market falls 10%, to get back to parity, you need to make 11%. Right.
So the next year you need 11% return to get back to square one.
Yeah. So if the market was $100, dropped to 90, it's 10% fall. To get back to $100, you don't need 10% because that'll be $99. You need 11%, right, to get you to 100. If the market, and then when you think about how much risk you want to take, if the market fell 25%, so $100 to 75, you actually need a 50% return to get back to $100 or thereabouts, right? Or if the market fell 50% or your portfolio fell 50%, you actually need to double your money, right, to get back to 100. So I think when you're thinking about returns and risk, people always, like you just sort of said with your technology fund, you went from $4,000 to $400. I mean, you need to make how much to get back 10 times, right? So you need 1,000% return to get back to where you were. Like, how likely is that going to be? So having a broadly diversified portfolio at the core, if not potentially the entire portfolio, but at the core, helps you reduce those, those very large falls and what you actually need to get back to parity. And it was just something that, people forget. 10% means 11 back, but 50% return means 100% back, right? So it's that's unbelievable, and people don't think through that maths, do they? And I have to say, when you talk to the really, really wealthy people like Warren Buffett that have made all their money, their solution is always, we focus on the downside. We want to make a good upside, but we always know our downside. And so people mistake that. They think the really successful people just focus on massive returns, but they are just as focused on what is the downside and how do we limit it. Correct. 100%.
Yeah. Okay, excellent. Well, we're starting to sort of get up towards the hour. So where I want to head on to now, Ian, is one last thing is ESG funds. And I just want to briefly talk on that, and then I want to duck out to fees and why that's really important, or costs of investing. So can you just give us a bit of a rundown on ESG? Because I think that's something that we're seeing in the papers, and I'll use the acronym ESG so you could explain what it means. Can you just give us a quick touch on that as what you're seeing coming out in the marketplace now?
Yeah, sure. So ESG, for the term, is environmental, social, and governance investing. So ESG investing is something that's become a lot more interesting or popular with clients over the last few years. Obviously, we've had recently the COP26, which is all the meetings of all the world leaders trying to work out how we can reduce global warming, by 2050. So there's been a lot of discussion there, which we can go into a little bit more. We've obviously had COVID, which is, like a health outbreak that, has obviously changed the way we've lived for the last, 18 months, 2 years. And then you think about environmental investing, we've had bushfires in Australia. There's rising sea levels and everything else like that. So ESG investing is investing with those areas in mind. So rather than just your capital, rather than just thinking about a long-term return, financial return, it's like, how can I also make sure my money is having impact in those areas as well? So we're seeing a lot of strategies that either look to, and at Vanguard, we think about it in 3 different ways, Ben. So either look to avoid harm, so not investing in areas such as non-renewable energy, such as fossil fuels, nuclear power, that type of thing. Not investing in weapons, not investing in vice products, so gambling, alcohol, and smoking as such. And you can easily exclude those options from your investments and just avoid harm. You've also got what they call, you can engage with companies. So that's, what we call investment stewardship at Vanguard. So that's where we're engaging with the boards of these companies and talking to them about the risks, such as climate-related risks, as well as diversity and inclusion and a range of other areas, and making sure that their boards has appropriate skills and expertise to make sure that they can manage those risks long-term, so the returns of those companies, and for our investors, continue to grow, but with those ESG risks in mind. And that's often usually the governance investing. And then you've got what you can allocate your capital, which is our third one. So avoid, engage, or allocate. You can allocate capital to companies that are doing good, I guess is probably the best way to describe it, Ben. So it might be someone who's, investing in, it might be Tesla, right? Which can be seen as a positive or a negative, depending on who you talk to. But, leading the way for electric cars, and electrification of, which will then reduce, obviously, emissions or carbon emissions. Or it could be, other areas. So it could be philanthropic as such, right? Where you're not actually looking for some sort of financial return, but wanting to do good in the future. And, you mentioned Warren Buffett before, but like Warren Buffett has gone to the Bill Gates Foundation I can't remember the exact name of the foundation, but essentially he's donating 99% of his wealth to that foundation to try and, use their wealth that, obviously got too much of it compared to the normal everyday person to be able to, focus on these areas of ESG investing.
Yeah. Yep. And I think it's really important is again, we're not suggesting that's where people should invest or anything like that. It's just basically these are the options that are cropping up. And we're probably seeing more demand from the younger generation when they're coming out saying we want to put these filters, and it's more of an avoiding rather. In a lot of first cases, avoiding certain things, and then a secondary is then targeting certain areas. So that's it.
Yeah, and just on that, Ben. So it's not nothing's ever binary. Like it would be using a combination of those different type of strategies to build a portfolio. So, you want to avoid harm as much as possible, but then you might have a passion for, I don't know, clean water, right? So then you find a fund that's like focusing on making sure the world's got clean water. It might be focusing on the transition to the low carbon, or it could be something to do with anything that you've got a passion or values that you believe really strongly in. And then you would use probably a combination of those strategies to help build your portfolio, even in an ESG manner.
Yep. So people have choice to
Correct,
allocate.
Yeah.
So yep. Okay. Excellent. Now, the last thing we want to get into before we wind this up, Ian, is fees. And I know Vanguard's talked about this for years. I've banged on about it for a long time. Is the cost and how it impacts over time. So just to give some context, I remember when I started the industry 20 years ago, if you went into a managed fund and you wanted to get into one, you generally had to have about 50 grand just to get started. And it's democratized so much now where you can have $1,000 or a couple of $1,000 and you can get in. So the entry has got a lot lower. There used to be fees to get into the investment. So I can remember at some stage there was up to 4% fee to get in. So if you put 100 grand in, you'd only invest 96 because 4 had be gone in fees, and there was exit fees to get out again. When all those have disappeared. But the big one, which is really important, is ongoing fees. So I'd like to talk about that, and I'll just give a quick example. Is when I started, I would see funds all the time that were over 2%. So I saw funds up to 2.6%. So that means if you earned, let's say 2.5, if you were earning, say, 10%, you've got to take 2.5% of that off. So you're back down to 7.5% return, and that compounds and impacts over time. Nowadays, I'd like to talk about what the average is, and I know some of the index funds, etc., now are getting down to about 0.2%. So down from up over 2% to 0.2, which is a big drop. So do you want to just touch on that for us, Ian, and maybe some numbers around how that can impact us long term?
Yeah, no, definitely. And fees. Yeah, I mean, I think you've been in the industry a little bit longer than me, Ben, but like just in the time we've been in, they've reduced and reduced and reduced, and the Vanguard. Just so you know, the Vanguard model, Vanguard's a mutual structure as such. So what it means is we're not public listed, or we're not privately owned. So at Vanguard, what we're doing is, once we've covered our costs, a small amount of profit, we give back to all the shareholders, which are the clients who are invested in our funds or ETFs, by reduction of lowering their fees. So in the Australian market, we've done that over 25 times for investors here as we've grown in size and scale. Now, when it comes to fees, the averages, I'd have to look up what the average is for the market in terms of, say, ETFs or the like, but you can literally purchase a ETF that invests in the entire US stock market for 0.03%, or what we call 3 basis points.
That's ridiculous.
Yeah, so for what is that? That's like for every $10, it's 3 cents. But it's very, very low cost. So if you're wanting to capture exposure and growth of the US share market, there's no other way you could do it cheaper than that. Like, you couldn't do it yourself. You couldn't own all 3,000 holdings in the US stock market, or even if you wanted just the S&P 500, which is about 80% of the US share market, you wouldn't be able to buy all 500 holdings, and even with the free brokerage and everything else that you could potentially get, manage that for, lower than 3 basis points. So it goes down there. Our Australian share market ETF is 0.1%. So, you're talking about 0.2. So, it's very low cost as well. And indexing or index ETFs and managed funds tend to have a lower fee than active managers, like you said. So, in excess of 2%, you still see many of the active strategies today in excess of 1%. but they are coming down. And, you know, they often call this, whenever Vanguard's entered a market, Ben, like the Vanguard effect. So you'll see, you know, whenever we enter the market with our index funds, all of a sudden fees in general start to come down. We entered, as you know, into active funds in the Australian market a couple of years ago. We've already seen fees slowly starting to come down in that space. So we're all about trying to get the cost as low as possible so the clients keep more of their returns. Now, if you think about long term, you know, if you're investing in superannuation or even after you've retired in pension phase, you potentially still have 20 or 30 years to go of your money needing to be invested to make it last a lifetime, or, you know, potentially to an estate or whatever it might be that you're doing. But if you think about a fee at 1%, you know, and the market...
Or even a 1% difference between.
Yeah, or so say 1% difference between fees. Over 30 years, that will be, you know, close to 30% difference in ending values of those portfolios. So the 1% fee, you know, the famous words are, you know, only 1%. Yeah, that's all it costs. Only 1%. It's like the famous 3 words, right, in this industry. But only 1% is so large and makes an extreme difference in how much a client has at the end of at the end of you know, a 20 or 30 year period.
But I think it's really important to stop on that point, because again, I'm a real advocate in paying good money for good things, so getting value. So I have no problems in buying expensive things if it's the better outcome. But I also believe that if you're not getting the value, you want to get the cheapest price you can possibly get for the same value. And if you said there's a 30% difference, correct me if I'm wrong on my maths. So if you invested and you built your portfolio up to about $1 million, if it's a 30% difference, you know, someone with the higher fee, assuming the same return, you know, taxes, all that sort of stuff, could have a 700,000, and the person that's getting 1% less fees could be getting $1 million.
Correct.
Yeah, and we've got to put the big caveat in there. That's assuming all things are correct. So that's making the assumption you get exactly the same return, the tax treated the same. So we're being very general in our calculations. But if we just looked at fees, which isn't the only decision, you know, we have to look at fees plus a whole lot of other things. But if we just looked at the impact of fees, that's substantial over 30 years. Ian.
No, it is. And people forget, like I said, the famous words of only 1% is just, you know, only 1%. That's a lot of money when you can buy, you know, said the Australian share market at 0.1 or the US share market at 0.03%. You know, it's basically zero, right? There's minimal drag there at all, versus 1% drag is like trying to carry an extra kilo of oranges in a 100-meter sprint race of the Olympics versus the person who doesn't, right? Or jumping the hurdles, if we think about it as a performance hurdle. So, you know, just to actually get the same return, you know, that means if you paid zero fee, which I mean 0.03 or 0.1 is very low, versus paying 1% fee, that means to earn the same total return after costs in the same year, you know, that person's got to earn 11%, the one who's paying 1% fee, versus the one who's paying zero is only got to earn 10%. Right, so when you compound 10% per annum versus 11% per annum over 30 years, that's where that 30% difference or thereabouts comes from, you know, in terms of the fee differential or the end outcome or capital amount. So people often have this short-term or, you know, linear approach to thinking about things, but it really becomes exponential as you start getting into year 20, 25 and 30 in terms of the compounding difference of the capital. So, you know, you could literally, rather than gearing, potentially keep your fees lower, you know, take a similar amount of risk potentially and end up with the same outcome with potentially less risk.
Yeah, exactly. And I think another thing is, Ian, is if we look at targeted investing, which we'll have to wind up now, but if we look at target investing, and let's say you've done your lifetime model or your retirement projections, and you say, okay, over the next 15 years, I've got to get a 7% return to hit my target. Well, you increase it by another 1% of fees, you're going to get an 8% return, which means you need to take on more risk to get the same potential return. Now, again, many advisors out there may argue with me, and I'm happy to have that discussion with them, but that's the mathematics or part of the decision-making process. So fees, I think, is really, really important.
And then one bit on that, though, is like fees is the one thing you can control, Ben. So, you know, you can't control the markets. You don't know if, you know, whenever I've done presentations, whether it be an investment market update for advisors and their clients, I often get the question, what are the markets going to do next year? And I said, I can actually guarantee you what they're going to do next year. I can give you that. It's going to be plus or minus 50%, right? I don't know which way. I don't know which one it's going to be. But that is, if I say plus or minus 50%, I've pretty much covered, you know, 99% of all the different outcomes for the next 12 months. But the one thing you can control is the costs and how much you pay. And so that is something that does make a tangible difference in the long term. And it's one of the reasons why Vanguard is always talking about costs. It wouldn't be a presentation without the talk about low fees. Is because you can control it, and it does make a meaningful difference when you start expanding the time frame out further.
It does. And I've, just to be clear, I've been a very big advocate of low cost. I believe that it's one of the things you can control. I just want to make the point that, it's not the sole determinant. Just because something's cheap doesn't mean it's good necessarily.
Agree. Yep.
So really what we've got to, Ian, just to do a quick summary is, we can go with direct shares at one end. We can go buy, sell, decide what we want to do. In the middle, we can have some direct shares, plus we could have some managed funds attached to it or exchange traded funds to get the diversification, or not all your eggs in one basket. And at the other end, we can use a diversified fund like a balanced or a growth or a high growth. You hear those names in the market, where you have less control, but then you're outsourcing that professionally to someone else to be able to manage that on your behalf. And I think they're the greatest options. And from people who want to access these things, they can do all their research, they can go get advice. But nowadays, you can get into these funds either through the stock market or you can go directly through platforms, etc. So there's many ways to do it. And I think these days it is so easy to get into investing compared to what it was when I first started in the industry. It was a rich person's game when I started in the industry. Nowadays, my nieces and nephews are investing. I mean, it's just a lot simpler today than it ever has been.
And you just hope that they all start early. Like it's always one bit of advice is start yesterday. And you mentioned before that you need $2,000 or $5,000. I mean, you can buy an ETF for $500 today. So you can start with as little as $500 and you can start your investing journey.
Yeah, I believe that's great. So Ian, we're going to run out of time today and there's a whole lot of other things we could talk about, but I'd like to end on, what do you think real wealth is?
Yeah, good one. It means having choice, really. So for me, the true definition of wealth would be, if I want to work less, I can. I'm not impacted in terms of the way that the lifestyle we want to live. If I want to travel more, I can, because I have the choice and the funds available to do so. If I want to sit at the front of the plane or the back of the plane, I can. Like I've got the choices. Of either going to a big four tourist park or to Versace on the Gold Coast or whatever it might be. It's just having choice is the true definition of wealth. So, and then the other part is like it gives you time so that you can spend more time with your family. So, big fan of outsourcing as much as I can, and then having time with families is definitely another true version of wealth or definition of wealth for me.
I agree, and I think most people will agree with that. Ian, is having choice is really, really important. You don't want to be backed into a corner, and I think educating yourself financially helps you make good financial decisions, which then compounds over time to give you financial freedom. So the ability to have more choice. The older you get and the more you build your wealth and your knowledge, the more choice you've got. So that's great.
And the more time for reading and trivia. So
Exactly. Dinosaur facts and unicorn facts. Excellent. Well, look, thanks so much for your time today. I really appreciate it. I'm sure we'll come back and touch on a few other topics later on down the track. And I know there's one that I've got in mind, which I think will be fantastic in the future. So thanks very much.
No, thanks for having me, Ben.
If you want to educate yourself more, go to the Vanguard Australia website. Just Google Vanguard Australia, and they've got some really excellent educational resources. I've read them, I've handed them out over the years, and they're just good, generic investor resources. Don't forget also, you can join our new private Facebook group, The Financial Blokes, Wealth and Wisdom. And finally, a reminder to keep the lawyers happy. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice, and you shouldn't act on the information without appropriate specific advice for you and your particular circumstances. Thanks for joining me again today, and I'll catch you with a new episode in 2 weeks' time.